Okay, so you've been looking around the internet, I'll betcha, and you're looking for information on the traditional IRA. Good news is you can stop right here because I'm going to go over everything you need to know really, really quickly, and I'm going to keep it very, very simple. All right, here we go. So we're going to talk about the traditional IRA today, and the first thing that we want to know, and I get this question all the time, is how does it work? And I want you to first picture a nice little basket. Okay? So the IRA is essentially just a basket. The basket has rules now. So the basket says you can put $5,500 a year into the basket, your own money. Now specifically, how does that $5,500 get treated? Well, let's say your paycheck for the month is $4,000, okay? And then there's some taxes, there's some health care, dental, whatever I don't know what you get taken out of your check. And you have $2,700 left over, okay? So we've got gross up here and we've got net down here. In a traditional IRA, the government says, we're gonna let you start with this number. So before you pay any taxes, whatever this number is, your gross paycheck, we're going to let you put up to $5,500 into this. Now, not in 1 month, of course, over time. After all that's taken out, you'll be left with your net number. Now, that's a big difference between this and the Roth IRA. Today, we're talking about the traditional IRA. So, you get to take money and put it in there before you pay taxes, okay? Now, what happens is that tax gets deferred until retirement. So, you've got this money coming in every single month, and you've decided to contribute $100 or $200, whatever it is, but you're gonna go no more than $5,500. Now, if you're 50 or over, you can do $6,500. It's just known as a catch-up. They're just saying, hey, you're getting close to retirement. If you wanna put a little more in, we'll let you go to $6,500, okay? Now, this is the big thing to keep in mind. You got to put this money in before you paid taxes. If you take the money out, you're going to have to pay taxes. If you take the money out early, you're going to have to pay those taxes plus a 10% penalty. So we don't want to have an IRA or treat it as if we're going to take money out as we want. This is not the vehicle for you. Okay, so we've got our $5,500 going into this basket. Nothing has happened with the basket yet. It's just this vehicle. It's just this, well, basket that we're putting money into, okay? Now here's the rules. The $5,500 is going to be taxed when you retire and start taking money out. So when can you start taking money out? The answer is 59 and a half. That's when you are allowed to start taking this money out. Now every year you're going to put money in. So maybe 30 years you've got money going in. I'm not even going to try to do that math, but you get the idea. This basket's getting bigger and bigger over time because you're putting money in. We haven't even got to the investments yet, just you contributing. You can take the money out at 59 and a half. You're forced to start taking the money out when you reach 70 and a half. So you're allowed to start taking out at 59 and a half. You are forced to start taking money out at 70 and a half. Okay, now, I get this question a lot. I put the money in an IRA. What happens? How does it make money? Well, specifically, the money that's in this basket, as it grows over the years, you're going to pick investments. So you're going to take some of that money and put it in stocks. You're not forced to. You can put the money essentially wherever you want, but you might do stocks, you might do bonds. These are all the popular ones. You might take some of it and go with ETFs, if you're familiar with that. And maybe you do some kind of I don't know, mutual fund. I'll just go like mutual fund, okay? And all of these products you're investing this basket into, and you're gonna spread it out. Now you can choose these investments as you please. You can just pick one investment. You could say, you know, I like Apple. I think Apple's just gonna be worth $1 billion a share one day, and I want all of it to go into Apple. I don't suggest that, but you could do it. There's nothing to stop you from doing that. So the idea is that as you put money in over time, you're gonna put it places. You're going to start making money off of all of these investments, and over time, the market averages a 7% return a year, going back forever. Now, to add to those returns, what we do here at Jazz Wealth is we take these investments, we help you pick them, of course, We divide this all up. We divide your basket up in a way that helps you get to your goals in retirement. So when you become 59 and a half, if you choose to start taking money out, then you have a big chunk of money to live off of. But what we do is really specific. When we decide the investments that we're going to put inside your basket, we then go rent them out. And we let other people pay you to hold those investments. Right? So while you're sitting there with your stocks, your bonds, your ETFs, whatever, your big chunk of apple, we're going to go find people to pay you money to rent them. Now the process is just called selling covered calls, or they used to call it buy rights back in the 80s and 90s or whatever. But basically, if you're going to look up what this means, it's called selling covered calls. It means that you're going to let someone rent the product from you, they're going to pay you some money, and you get to keep the money. If they decide they want to buy the product from you, at some point down the line, they may do that. But it's not like a given. They're not definitely going to do it. And so that's what we do. We work on your basket so that as you're putting money in, we're helping you grow that basket even more. Okay, so as you get older, you've got your basket, you've been putting in money, you're $5,500 or more every single year, and now it's time to start taking the money out. You have reached the magic 59 and a half, and you want to start taking money out. Now you're going to pay the taxes, okay? Because remember, we put the money in before we paid tax on it. So here's what happens. You got to put all this money in, you chose the investments grew over time, you're retired or you want to retire now, you're going to start taking little bits out at a time, whatever you need. You don't need to take all of it out in one shot. You can take, $2,000 a month, $5,000 a month, whatever you decide. And so now the government's going to say, hey, we let you skip out on the taxes when you're putting the money in, we'd like that money now. Now this is a good thing because when you retire, you've got this big basket that's worth all kinds of money because you've been putting money in, but you're only taking a little bit out. As you take some of the money out, you'll pay taxes. Think about it. If you took $1,000 out a month, then you're not going to have a very high tax bill. You'll be in the lower tax bracket. Now, we don't know what taxes may be, but you're going to be in the lower tax bracket, okay? So it's better to pay the taxes later in you're going to pay the taxes later in a traditional IRA, but the goal is to be in a smaller tax bracket so you won't pay as much tax. Okay, lastly, we have a couple side notes here. Couple things that I get asked all the time when it comes to these traditional IRAs. You're allowed to take out at 59 and a half. You're forced to take out at 70 and a half. It's called required minimum distributions. If you don't do it, they're going to tax you, so you're forced to take the money out. All right. The other thing to consider, when you're putting money in, hopefully you're growing, you're making more money, and you just get to some position in your life. Maybe you own a business or you work for someone that's paying you a lot of money. I hope that's the case. There is no income limit. Some retirement accounts have an income limit, meaning if you make too much money, you can no longer put money into it. The traditional IRA does not have an income limit. Okay, another thing to keep in mind is that if you have a 401k at work, that's a different type of retirement account. This may be an account where you put a little money in and your employer puts a little money in. It's free money, right? So they may help you out. You stay working for us and we'll put in a couple percent of your paycheck. We'll give you that money, we'll match it, and we'll put it in your 401k. If you ever leave that job, you can take the entire 401k and stuff it into your IRA basket. There's no penalties, no fees, no nothing. That's something I can help you with, and no one should ever charge you to do that, really. It's just a simple move. You take it here, you throw it in your basket. So that's the traditional IRA in a nutshell. Now, you can take the money out early. There will be some penalties, there will be taxes. No one's going to stop you from taking money out, but you're going to get hit there, so try not to take the money out. There are a few exceptions, college, medical bills, first-time home buyer, some other things that allow you to take the money out without paying a penalty. However, you're going to want to talk to a professional because if you make one wrong move, they're going to penalize you. Well, hey, look, if I can help you, if you have an IRA and you want to rent those positions out like I was explaining, go to our website, check out some more videos that explain in detail how this process works, or just give me a call. You can go to our website, schedule a call up at the top, and I will get with you when it works for you. Hope to talk to you soon.